Okay, welcome to our ACCA F9 course. Today we will go through class 7, the 7th class. And here is the agenda for the topics to be covered today. And first of all, we will introduce the business valuation and explain why do we need to have the business valuation, especially why do we have the business valuation topic in F9. Next is about the equity valuations and debt valuations. Under the business valuation, we have two big topics will be examined. The first is the equity valuations. The other is debt valuations. And I just remind you there's different methodologies in the equity valuations, but for debt valuations, it is only have three kinds of debts to be valued. So I think in the examination, it will I think you will have the questions around this valuation topic in section A and some in section B as well. So and then after the valuations, we'll talk about efficient market hypothesis, and also the theories explaining why share price changes, the types of EMH, the efficient market hypothesis, and also the implications. For EMH, I can see the questions will be in section A or some in section B, and it is quite often for the examiner to put these questions in, for example, in section A. And the marks is not so difficult to get, but it's very important for you to understand the rationale and the theory behind, so that you can make the choices among four. For example, in a multiple choice question, you can make the choice among four options. Or if under the other objective test question type, then you have to, for example, true or false, then you have to choose the statement correctly. All those are the facts. So it's not about application, it's about your knowledge. So if you have the basic knowledge, then you can answer them well. So first topic is why do we need to have business valuation? And for the business, okay, growth is very important. Okay, growth is very important. There are two ways to grow, or there are two ways of growth. The first is about organic growth or internal growth. So what is organic growth? It means the growth is by the internal resources. For example, the retained earnings or the funds generated from the operations, and it can sustain the operation as well as for the growth for the business. But resources are limited, so we have to make choices among different projects. For example, in the investment appraisal topic, as we shared before. Okay, do you remember the capital rationing? Okay, for the capital rationing, it means we have to choose projects. For example, we have 4 projects to be chosen. Then we have to decide which projects that we have we can invest based on some rules that we shared to you before. So it's about organic growth. For example, we have the funds available. For example, only $100 million to invest. Then we have 4 projects. Total investment cost may be more than $300 million. Then we have to utilize our funds to optimize the value the project generated. So we have the capital rationing. Then it's about the organic growth. And other than organic growth, we have other growth as well. We have acquisition. Acquisition means we have the funds available, but we would like to acquire the business outside our current business. Okay, outside our company. We would like to acquire the other companies. No matter is, for example, the acquisition can be classified into 2 ways. The vertical acquisition and horizontal acquisition. Okay. Okay. What is for vertical acquisition? For example, if you are in the garment industry, you own a factory to produce the clothes, the garment, the finished goods of the garment products. Then you have vertical integration. For example, you buy a textile company, or even textile means it produce the clothes for you, to make your garment products, or you even go to buy farms, for example, for the cotton. Okay, you ensure your supplies of raw materials, for your production. So it's the vertical acquisition or vertical integration. Okay, vertical acquisition. For the horizontal acquisition, you can buy other factories. Okay, to expand your capacity, or you would like to reduce the competition. Okay, for the horizontal acquisition, it is the way to reduce your competition or the way to expand your capacity to fill up your demands. And for vertical acquisition, it has to ensure your supply chain is on a more smooth way to work or to operate. For example, you acquire a textile company, or even you acquire farms for the planting of cotton to ensure you have the raw materials to produce. Or you can, for example, go the other way. You buy the retail outlet, okay, to ensure your goods can be sold in the market. So the acquisition can be in at least in the two ways. Okay, for organic growth means you have the management, you have the management need, for example, to ensure the company has the resources to grow. To ensure the company have the resources to grow, and for each department can be cooperated. Each department can be cooperated so that the resources can be utilized. And for evaluation, it means the project or the proposal should be evaluated in a proper way to ensure the investments can be done on the right track. It's all about the information that you gathered. For example, in the company that has a different projects, as I shared with you before, for investment appraisal, you have different projects to choose. Then for the evaluation, it means you have to apply your investment appraisal techniques, but you have to gather the proper or the adequate information for you to do the evaluation. If do it in the wrong way, then it means your investment appraisal or your NPV calculation is incorrect. Then the problem is you make the wrong investment decision. And monitoring means once the decision is made, then the management or the top the executives needs to monitor the progress and to ensure the cash. For example, if you apply the investment appraisal techniques like NPV or discount cash flow analysis, you have to monitor to track the cash flow generated is in line with what is written down in the investment appraisal proposal, so that you can keep the you can monitor the progress. If it is deviated from the investment proposal, then you have to find a ways to fine tune it or to get the right back in the target. So it's about the monitoring. And next, we will talk about acquisition. As I share, the acquisition can be, for example, taking other business, which is the fastest way to grow. Acquisition is the fastest way to grow, and it can also, it is the best way to acquire knowledge or talent in the market. For acquisition, why the company would like to have the acquisition in order to grow, because it is the fastest way to grow. Okay, it's that only you pay for it, and then your capacity will be increased just overnight. And the other advantage of acquisition is you can acquire the knowledge or the talent in the market. For example, you have to build a talent pool, maybe say 5 to 6 years, but if you acquire the other business, just say 2 months later, you have the talent pool in order to build or to grow your business. It is especially important for the technology company. Especially important for a technology company because the technology company may have a lot of the technology company in the market, but in some areas, for example, I think you have already heard a name like Microsoft. Okay, Microsoft is a very big company, and it has a lot of acquisition like LinkedIn, right? So it acquired LinkedIn because it is the fastest way to go into the social media market by just to acquire. If Microsoft would like to build its social media, it has to spend a lot of time and also resources in order to build in the market. So the fastest way is to acquire the other business. Also, as said, achieve the business objective in a short period of time. As shared with you before, we have the horizontal acquisition, which means you can increase your capacity just in a short period of time, or you would like to ensure your supply chain, your raw material supply, or your outlets, your retail outlets, then you have to go into the vertical acquisition, which is the fastest way to grow as well. So how to finance your acquisition is another topic, and after this topic, we will go into the valuation. So here is why we need to do the business valuation. Okay, the other one is, okay, for acquisition, you have to pay for the acquisition, right? So right now is financing for acquisition. So last topic we'll discuss about the value of acquisition. The financing for acquisition, first of all, you can pay cash. It's the most common form of payment for an acquisition because it is the most acceptable way for the payment. Okay, it's for example, it's fast, and a lot of people would like to have the cash instead of other consideration. Earn out, a payment method combined with cash and other consideration. A typical example for earn out is you would like to buy an asset, okay, but you don't want to pay all the cash initially, so you would like to pay the down payment first. Say 50%. Okay, the other 50%, okay, you would like to have your goods now, and then by installment. Okay, say for example, you buy goods, you buy a certain machinery. I would like to say machinery. When you buy it, okay, first of all, you pay your down payment, say 50% of the lump sum of, let's say here is 10 million. You pay 50% means pay 5 million first, and then for the other 50%, you pay it, say by installment or by some conditions. Like the machine can perform well, can deliver what you expect, and also can deliver the profits to you. Okay, just an example. Then you will pay for it. Earnout is quite similar to what I described for the payment on the machine. It means the payment method comes out of cash. Cash means you have to pay now. Another consideration, maybe for example, I pay it later, or in other forms like shares or other assets. But most of type of earnout is you pay say 50% or 80% initially, and then you pay the remaining balance by a later period of time. It's about the earnout. The advantage of the earnout is it helps the buyer. For example, it helps buyer to have more liquid position, and also when you buy a company using the earnout payment method, then it helps the buyer to see whether the company buying is valued or not. For example, if it expects the company can generate say 5 million in 2 years, but it cannot do it, then it can pay less. Okay, honestly, it can pay less for it because it cannot meet the objective or the target by the buyer. So it's the advantage of it. Share exchange. Okay, share exchange means to take over by offering shares in the acquirer. Okay, it is a paper consideration. It is a paper consideration. It can preserve the liquidity of the buyer, and also for a company with a quite high gearing, if it can issue the shares to buy a low gearing company, it can finally combine two companies together with low gearing ratio, which is a good strategy for example, high debt company. But for disadvantage is the share price may be depressed for share exchange because a lot of shares will be issued for the acquisition, and also the ownership will be diluted. So next is long stock, not lock stock. Okay, long stock or debentures for share offers. Okay, long stock is not very popular now, but it was very prominent in 1960s, so long years ago. For example, a company can issue the debentures to buy the other share to buy the other companies by using the debentures. The debentures or the long stock can be a floating rate loan or a fixed rate loan. So it depends, but because it's not very popular now, so I just describe the terms and for your information. And also convertible instruments like warrants as well. The company can issue the convertible shares in exchange the other company's shares as well, but also it is also the combination, maybe the combination with cash. All right. For convertible instruments, the advantage of using it because it can lower the cost of interest, because finally it can convert into shares, and also even it will dilute the ownership of the acquirer, of the bidder, but it is a delayed dilution. So it has a way, for example, to buy back the convertibles if it has the adequate cash. For warrants, it is a document, or it is a right for the warrants owner to buy a company shares at a specific price, Okay, it's a right, not an obligation. So it's very similar to option. Right, but not obligation. Okay. So all these can be used to finance on the acquisition. Okay, this part we go into the details of the valuation, market value during the takeover. Okay. Once a company, for example, company A announced to acquire company B, and both companies are listed, it means the shares are traded in the exchange, in the stock exchange market. If company A announced an acquisition on company B shares, and the acquisition is, for example, in different form, maybe first a cash deal, B, or the second one is share exchange or share for share. Okay, what's the market value or what's the share price movement will be? What's the share price movement will be? For example, if a cash offer to company B, maybe the market accept the cash price is good, then company B share price will increase, right? Okay, to what A offer, for example, the market price traded before the announcement is say $5, and the cash price offer say it is $7, then the company B share price will go up close to or a bit below than $7. Okay, maybe just smaller than $7. Okay, because there's an uncertainty, the company B shareholders would like to decline the offer, so this is a risk. Then the price will be lower or maximum is same as $7. Okay, maybe a bit lower than $7 if a cash price. Then it's straightforward. For company A, the price performance, it depends, because maybe job flat or up. It depends, because it depends on the market. Accept this acquisition will create value for company A, so it depends. But for share or the share exchange offer, let's say company A share trading is at $10, company B is at $5, and company A announced that they would like to exchange the shares. Say, for example, one A company, okay, or two company B shares can exchange for one company A shares. Okay, just an example. Then, for any change in the share price of A will be linked to company B, or any change in company B share price will link to company A after the announcement. Okay, because there's an offer put on the table, then the investors do know the value between these two companies. So they just, for example, they just look at the price between these companies, and then they can make the decision whether they would like to buy company A or company B. If company A share price would like to go up, then company B the price would like to go as well. But it is going in the same direction, but not in the same proportion. Okay, maybe a different magnitude between these two movements, but they should go in the same direction. If the share price is going up, then the deal or the acquisition or the chance for the acquisition is higher. But if the share price for A is not performing well, then the company B shareholders would like to say, no, I just run away. I don't want to be acquired by company A unless unless my share value will be go up after the, for example, after the acquisition. So it's the market value during the takeover. And next, we move to the earning per share and PE ratio. It's about what we call is, for example, for the EPS, earning per share. Earning per share after the acquisition will be go up or going down. It depends for any new shares to be issued, right? If more shares to be issued and for the earnings that has no significant impact or the earning impact is not that big, then the problem is the earning per share, say, if it's going down after the acquisition, okay, then the share price will be affected. Okay, for earning per share, even it is an accounting figures, but a lot of people just like looking at this indicator. So earning per share still affected the people investment decision. But PE ratio would like to talk about here. For PE ratio, when a company, for example, company X, PE ratio is 15 times, and company Y is 10 times PE multiple. Okay, when company X announced to acquiring company Y, what will it be for the PE ratio, assuming the size is more or less the same? For example, both company has 100 million market cap. So for company X announced that I will buy company Y. So what's the impact of the companies merged together? The PE ratio should be smaller or bigger than 15 times. It will be lower, right? It will be lower. It will be dropped maybe from 15 times to say 12.5 times. The PE ratio drop. So is it a good news? Is it good news? Yep. It's a good news because for the company X shareholders, okay, they are happy to see a lower PE, means their investments payback will be faster, will be sooner. Okay, once a company PE ratio is higher than the others others targets for acquisition, it is something like company X would like to acquire the other companies because, for example, it can pay cash or it can use the shares. Okay, when it issue the shares to buy the company Y, then it is more beneficial to its shareholders because it is a higher valued company buying a low value or a relatively low value company, which finally it can combine with a company that the payback period for the shareholders of X will be a much faster or much sooner than the others. Okay, so usually a high PE multiple company, okay, would like to acquire a relatively lower PE multiple company. Okay, but in the opposite, a low PE multiple company is difficult to acquire a high PE multiple company because the shareholders, or for example, if shareholders of company Y, if it announced to acquire company X by issuing new shares, okay, the shareholders of company Y would like to say, why I pay a higher price to buy the other company? Okay, because my company shares is undervalued at a lower PE ratio. So in general, a higher PE ratio company acquires the lower PE ratio company. Okay, it's the market practice.